Hello and greetings. This is Larry Tantarelli with a brief members blog and video for Blue Chip Daily Trend Report. Today is December 5th, 2021. Before we get started, I'm going to touch base on the disclaimer. And what this says is that everything in the video is for informational purposes only. It's not a recommendation to buy or sell any securities. It's not to be considered investment advice, and past performance has no bearing on future results, among many other things. So what we're going to do is I'm going to spend a few minutes and we're going to take a look at this week's Fed pivot. So before we get started, quickly, educational purposes only, and we went through this, but this is only a historical look at past rate hiking cycles. So what that means is that each market environment is unique. So there's no implication whatsoever that what happened in the past will happen in the future. This is a different world. Each market environment is unique. We're going to take a look back to 1994. The world's a different place since 1994. So really what I'm trying to really stress is that in no way am I saying that what happened in the past is going to happen in the future. But what I do is I do my due diligence. So when I see the Federal Reserve pivot on their view and change their stance, what I want to do is I want to go back and look at what happened in the past to see if I can at least get prepared for maybe what I should expect or could expect, what to look for. I'm always going to focus on the current charts and manage my risk based on what's happening right now. So based on that being said, this week's Fed pivot. So Fed Chair Jerome Powell on Tuesday, November 30th, he made a statement that the Fed could, and I'm going to emphasize could, that they could step up their timeline for taper and possible interest rate increases. Right after that, markets had a very quick response this week. Long duration stocks. Those are stocks with no current earnings and or very high valuations, high price to sales, a lot of cloud stocks, a lot of at-home stocks, a lot of momentum stocks, and a lot of growth stocks sold off very sharply. There were some growth stocks that were down 20 to 40% on the week. Conversely, 279 large caps did close higher on the week. So we had some healthcare concerns. Powell came out and said the Fed could start to tighten, and there were still 279 out of about 890 large caps that closed higher on the week. Of the top 20 performers on the week, 19 stocks have current earnings. Of the bottom 20 performers, only one has current earnings. So we saw a big shift this week after Powell made his comments, and companies with current earnings led the large caps. Companies with no earnings, they led to the downside. The bottom performers were very weak. So we're going to take a look at Fed rate hikes. So before we get started with the Fed rate hiking cycle, we're going to take a look. The website that I used for my data is thebalance.com, and I'm going to include this link at the end of the video. But basically what this is a history of Fed rate hikes, and what it shows is that the Fed began targeting the money supply to fight inflation in 1979. And what I found from 79 until 94, there wasn't a lot of relevance. So we'll go down, and you can obviously look through this at your convenience. But in 79, rates were 10 and a quarter. They started to hike, and then they took them up to 20%, and then they came down to 8.5% 3 months later, and then they went back up to 20%. So in all of this, there was really no relevance from 10 to 20 to 8 to 20. I couldn't really find anything of use in there as far as comparisons go. In 1981, rates started to come down. 1982, we can see they were bringing rates down. 1983, about equal. 1984, up and then starting to come down. 86, coming down. 87, Greenspan took over. So rates had come down from 84 to 87, down from 11.5 down to 5 and change, 6 and change, but they had been on a downward trajectory. Excuse me. And then we're going to go to 1990. Rates are still coming down. 91 coming down. 92. So now we're going to go to 1994. So 1994 is the first of the major rate hiking cycles. So we're going to take a look here. 4 major rate hiking cycles, starting in 94, 99, 2004, 2016. So here's what we're going to see. And I'm not going to spend too much time on what actually happened as far as market performance, because as I said, the key thing is I'm not trying to say that anything that happened in the past is going to happen in the future. But what we've seen is a narrative that's going around that basically said that anytime that the Fed raises interest rates, that the markets automatically go down. So what I wanted to do is do my due diligence and do my back testing and find out what actually happened. So I'll share just briefly the results, and then we're going to spend more time focused on what sectors and styles and factors historically perform better and what perform worse. So quickly, 1994 rate hikes. They started February 4th of 94 at 3.25. It continued till February 1st, 1995 at 6.0. There were 7, so 1, 2, 3, 4, 5, 6, 7 rate hikes in a year. The S&P started at 480. It finished at 762. There was a 9% pullback. So we'll take a look. So February 4th is when they started. February 1st is when they ended. So February 4th is when they started. Right after the start of the rate hikes, there was a pullback of 9%. So from the beginning to the next couple months, there was a 9% pullback. They hiked rates 7 times. Let's take a look. Yep, 7 times in there. They traded around sideways. It was a flat-ish market. They finished hiking rates here, and then the markets pretty much went straight up. So we had a pullback, a sideways consolidation. Now keep in mind, this is just the S&P 500. This is not indicative of what stocks and sectors did. Some were higher, some were lower. But then after they finished hiking, it was pretty much straight up. If we go to 1999, they started hiking June 30th of 1999 at 5%. They finished hiking May 16th, 2000 at 6.5%. 6 rate hikes. The S&P started at 1,300, finished at 1,553. In the same time period, the NASDAQ 100 more than doubled. So we're going to go to June 30th. They started hiking rates here, 1,300. A little bit of choppiness, up, down. Then it finished 1,553. Then the market started to roll over. So from the beginning of the rate hikes, a little bit of chop, a little bit higher. Then the markets did roll over. We're all familiar with what happened in the 2000 stock market, but that was after 1, 2, 3, 4, 5. So it took 5 rate hikes. And then after the 5th rate hike, the market started to unwind, but there was a lot of excess leverage in the NASDAQ. But in either case, from the first rate hike, a little bit higher, a little bit of a pullback, then it went up about 19%. Then things started to break down after the 6th rate hike. 2004, 16 rate hikes. So June 30th, 2004, 1.03%. Not sure how that got there, but that's what it was. They finished June 29th of 06. So 16 rate hikes. And we can see just by taking a look, there was quite a few, and they were very consistent with their rate hikes. The S&P started at 1140. It continued much higher, and there was a 7% pullback along the way. So we can see they started hiking here. Markets had a 7% pullback, started higher. They finished hiking rates. So keep in mind, this is 16 rate hikes in that period, and then markets continued higher. So there was a pullback in the beginning, and then there was a pretty sharp move over that time period. 2016, So there was 8 rate hikes. So they started hiking rates December 15th of 2016, 0.75. There were 8 hikes along the way. S&P 2250 to start, 2940 to finish. So if we take a look, they started hiking rates December of 2016. This one just pretty much started to go straight up, 2940. So the 7th rate hike was here. Then after 7 rate hikes and a 30% move, S&P started to come down quite a bit. They put in the last rate hike, and then the market started to go in the other direction. So if we look from that one, that was pretty much straight up. Now, as I said before, there's no implications. So we saw 2 times they hiked rates and the markets pulled back, and then they went much higher. And then 2 times, for the most part, they just pretty much went either sideways and up or up. So there's no clear, they're going to go straight up or they're going to pull back. It's been mixed. But in either case, what we can see is the longer term picture. If we take a look at all of these, this was about a 8 or 9 month process, and then there was a pretty big unwind. And then we can see in 94, it was a major move afterwards. So the end result, what I wanted to show there, is not any implication of what the markets could do, but just that in past rate hiking cycles, it hasn't necessarily been straight down, which is what the narrative is. So here's what I want to take a look at, because this is more important. So the key thing is what historically works well and what historically doesn't work well. So I did a considerable amount of research. I got my hands on some Bank of America research. It was about 116-page report, and I spent the past 3 or 4 days or 5 days, whatever it's been, really dissecting the report. And I'm not going to share the report. It is available to the public, but if I shared the report, I would really have to share all 116 pages and all of the disclaimers, and that's more than what I think people want to see. So what I'm going to do is I'm going to give the cliff notes of what I took from it, what I'm going to be looking for, and as I said, obviously the most important thing is what the current charts do. So regardless of what happened in the past, there's no guarantee that that's going to happen going forward. But what I will say is that over 80% of large cap trading volume is institutions. So, and institutional money managers for the most part are all looking at the same research. So it's very easy for Bank of America, JP Morgan, Goldman Sachs, whomever it is, they do the same thing now I did a very, very basic look back. They go into much more detail statistically because they can. But they're all looking at the same research. And here's what the research says. The research says that historically in these Fed tightening cycles, the research says that the stocks and the sectors, we're going to talk about stocks, sectors, and factors, high quality stocks with current earnings. So high quality are considered stocks that have stronger current earnings, strong balance sheets. The market looks for strong cash flow, which is strong earnings, and that also includes dividends. So stocks that can generate cash right now tend to perform much better than stocks that have no earnings and no dividends, and these high growth stocks that are supposed to, generate earnings 5 years down the road. And that's why we saw stocks like Hewlett Packard go up 8%, and some of these cloud stocks go down 20 or 30%. Hewlett Packard's got earnings and dividends. Lower volatility stocks, which tend to fall into this category, and then lower valuation. And the valuations that were most cited, low enterprise value to EBITDA, which is earnings before interest, tax, depreciation. So that's one valuation metric. High free cash flow to enterprise value, low price to book, and then a low PE to the growth rate, which is PEG. And then from a technical perspective, price momentum, 30-week over the 75-week moving average. So basically stocks that were in a longer-term uptrend tended to continue that fit into all the other categories. Currently, based on there are 11 S&P sectors right now. there's just 11 S&P sectors. Based on where they stand right now, energy, materials, healthcare, and financials, and select technology fits best into this category. So once again, there's no guarantee that because this worked in the past, it will work in the future. But what we did see last week is we saw stocks like Hewlett Packard up 8%, single digit PE, dividend yield. Off the top of my head, Seagate Technology, low PE, dividend yield. Dell Computer was up. A lot of the healthcare stocks were higher. Apple was up on the week. So what I want to do is, first and foremost, I want to look at what's working in the market. And then I want to have my playbook here and say, is the market starting to move into what's worked in the past? And what we saw last week is the answer is yes. So now, do we see that going forward? It still remains to be seen. Here's historically what underperforms, and we saw it last week. Long duration stocks with no current earnings. These stocks that have no earnings whatsoever, and they trade for 20, 30, 40, 50, 80 times sales. Historically, they do very poorly, and we saw that last week. Stocks with very high valuations and higher volatility stocks. So traditionally, what we in a nutshell, what we saw last week basically falls right into this playbook. And this playbook was put together before last week, but what we saw was the market reacted very quickly. And these stocks, for the most part, especially up here, performed much better last week. And these stocks didn't perform very good at all. What I expect is, if the Federal Reserve continues on their tightening path, what I would expect is that the market could continue to move into higher quality stocks, current earnings, strong cash flow, dividends, reasonable valuations. Now, the FANG stocks, in my view, Microsoft, Apple, Facebook, Netflix, fit into this category. But they're correcting, and I think part of the reason they're correcting is because these cloud stocks have just really put a lot of pressure. But semiconductors tend to fit into this category. If we take a look at semiconductor stocks, you'll see they have lower basic valuations, and most of them are profitable, whereas cloud, not profitable for the most part, and much higher valuations. Also, energy. So energy really falls into all of these categories. They've got a very low valuation. They've got a lot of cash flow for the most part, high dividends. So I'm going to wrap this up. I don't want to take too long. No predictions whatsoever, but we know, so we saw what's happened in the past. Sometimes there's a pullback after the rate hike. Sometimes they go straight up. But what we did see, I think in every instance, was that the markets moved higher after the rate hike. Now, once again, no implication that happens this time. But what we didn't see is the Fed hiked rates and then the markets just went straight down. We haven't seen that in any scenario. Now, that could happen this time. We don't know. So that's why we just have to stay focused on the charts. But this is the Fed tightening playbook based on how I see it and interpret it. And I'm always going to focus on the current charts, but this is just something else to keep in mind. So I appreciate everyone's time, and I will get this posted shortly. Thank you.